Hello guys, and glad to have you on board again. Today is Fed meeting day, and therefore we're going to talk about the stock market. And before we go any way further, I would like to tell you that some of you might have noticed that there was no weekly update in TradingView this week, and basically, to be honest, I just couldn't figure it out, and it's not my problem because it's basically sounding like a technical issue. But some other traders have absolutely no problem recording videos, which sounds like a local problem, which I intend to find a solution, but I hardly have the time to investigate, which means if I can find an easy solution by the end of this week, then of course right by next weekend we'll be back on track with these weekly updates into TradingView. But that also means that if for some reasons I just couldn't find enough time to figure it out, well, eventually right by next week we'll also make the weekly updates into YouTube until I find the appropriate time to work it all out. So that's pretty much all about it. Anyway, today is going to be kind of a weird mix because we have to catch up on the weekly update that has been totally missed, and also talk about an intraday update because today something really interesting is showing up. So first and foremost, let's start with the stock market. So in a broad market perspective, still the same old stupid context we were dealing with multiple weeks ago, and still the same old music. Not enough volatility, not enough things to work with, not enough momentum, not enough of everything, not enough volume, not enough. Well, the market is just dried out of everything. Life, liquidity, volatility, it's just, I don't know what that is, but the broad market measurements, S&P 500 like, are just as boring as they could be. Of course, lots of things happen into individual stocks, and we've been mentioning that multiple times in a row. That's also the reason why we've temporarily halted the weekly updates for stock market reviews. So today we're going to catch up on this because, of course, Fed Day means something could change today. Even though I hardly think it is, we're going to explain how I got to that conclusion. So first and foremost, technically speaking, there's nothing to talk about. There's not enough volatility to make any statistically viable reading of these markets. I don't understand why we're trading all-time highs. I thought we had reasonable probabilities to have built a market top. Now we haven't came up for this, which means we could be double top reversing. That's something that happens. It's not the most statistically viable outcome, but it's still probable, and we can see that lately we've done so many of these double top structures that I wouldn't hardly be surprised if the market were on the verge to reverse today. If it does, and only if, then huge pullbacks can be assessed, as in my personal opinion, we will not be able to find suitable buying entries until we retrace to the moving average territory, which is just like 3,500. So as always, and as we've been mentioning this so many times, I hope you got the point. There's no way you can anticipate selling this market. It's a goddamn complicated situation, even for experienced traders who are reverse trading. I myself have been just losing money all year long trying to cover the portfolio. Eventually, this will turn out to be profitable in a couple days if we fall off the cliff very violently in some kind of a flash crash structure, whatever. But this also seems like, as time passes, this seems like the less likeliest outcome as day-to-day works out. Because basically, we're just going all-time highs and all-time highs. Of course, value hasn't shifted at all. The only thing that has shifted are prices, but prices are what drives profits or losses. And so far, covering portfolio, even though it seems like the most rational risk limitation option, haven't been a profitable situation for reverse traders. So I still am not confident being full bullish into this market. That's the reason why I'm basically off market, just selling as much as I bought. And in that perspective, I'm pretty much like neutrally out the market. Of course, that's not what it is, because some stocks are rising and the broad market is rising, but not all of the stocks are rising, and not necessarily the ones I own. So I am fearing for potential volatility to emerge. The Fed will eventually do it. What is this all about? It's just all about the words, as usual, because when there is a press conference of the FOMC meetings, this is basically everyone's taking and paying attention to every little detail and hidden details into the words chosen by the Fed representative, Jay Powell. So basically, right now, the consensus is all about the same old stupid shit, all about inflation perspectives, job reports, and taper tantrum, which is basically, are we going to slow down the injection momentum, yes or no? Are we even talking about it? How many of the FOMC members are talking about it? All of the questions will be targeted to these three topics. What matters to me is how are they going to be mentioned, or if there's ever going to be mentions of this into the press conference communicate itself, which means the paper that it's going to be written by the FOMC members committee, and basically GE Powell going to read it, okay? So we'll see all about that. I'm really questioning what they put it in there, and then we're going to focus on the dot plots that will emerge later when we'll get the FOMC minutes. But still, okay, so let's take a brief moment to talk about these three major aspects. First of all, the job market. The numbers we've got are just absolutely wrong. We all know as professionals that the numbers that are rightly assessing the reality are the ones of U6 unemployment numbers, and they have been locked down by the 10% level, which means we can hardly go below because this is structural unemployment levels for the US economy. We can hardly go beyond below these 10% threshold because it is the maximum we can get out of the current economy. This is structural unemployment level at a crisis level. Are we in a crisis? Yes, we are. So we're not going to go below until further notice, and definitely not now. So we've reached out kind of a tipping top for the unemployment markets to increase its solidity. It's not that bad, don't get me wrong. It's just that 10% is going to be hard to break without significant investment into these sectors. Investment that we're not doing because basically all of the money is rippling into the stock market now. Then secondly, we got to talk about inflation. Inflation is a huge problem for the US because the CPI numbers have basically been measuring different stuff all across the board. We have historical readings of the CPI numbers, and we are now at the highest pace we've seen since 2012. But still, that means we're 10 years old into inflation numbers, but still, numbers were significantly different in what they were measuring 10 years from now. So we can hardly compare something that doesn't make any comparable sense. So in that perspective, if we have a look at true market readings of inflation, man, we really are going to fall off the cliff because it's basically inflationary pressures over 10 years. We've always been inflationary. So this lack of inflation that the central banks were always talking about are just statistical illusion. We've always had inflation. It's just it was hidden in areas in which basically those who were looking at CPI numbers weren't even able to see. The real inflation in the real life, everyone saw it. It's basically paycheck not rising and the cost of living rising, which puts a little bit of buying pressure to the downside. Of course, we had kind of compensating each other, which had slowly rising paychecks over a inflationary pressure compensating for it, which means poor people didn't get poorer, but they certainly weren't getting richer, which is not the case for, of course, the top 10% of the population, not even to mention the top 1 who's got crazy fucking richer as ever over the latest decade. So, huge problems with this, but that is the typical situation of liberal markets and liberal policies. We all know about that, so this is nothing new. What that means is that the CPI numbers we're caring about are actually just false. And do we have inflation? Yes, we have. That's just not even a simple. That's a simple answer. Yes, we have some, and it's not emerged from the COVID crisis. It's just made it visible for the indexes that measure it the wrongest possible way, the worst possible way. So it's really all about that. CPI numbers. Tantrum right now is like not really a thing. It's a thing we should have cared about for 10 years now, and we're just coming along with it today, which might cause a little bit of a crack, not necessarily into market prices, but if people truly realize that the measurements we had of inflation are just wrong, well, eventually that could cause a rapid reshifting to reality. And with a topped-up market into the topped-up job market, that means we have little room for improvements into stock prices and into the bullish perceptions of the market. Still, that leaves us with a final pillar, which is basically monetary policy. And that's the reason why we care so much about the Fed and what they're going to say. Because basically the only thing that can drive up a little bit more upside potential into stock pricing is more available money, which means the monetary-based inflation immediately ripples into the stock market. So as long as we inject money, prices will just keep rising at that very slow pace, limited by both a topped-up job market and now probably risks over inflation. But still, that leaves us with, as long as money pours in, we have to price that into the stock market, and we can hardly figure out bearish pressure potential until we get the taper tantrum stuff, which is basically the same old stuff as we've had back then when the first QEs have had to ripple off the table. This is really what we're having now. People are questioning how long are we going to get those levels of money, and you need to figure out that the stock market doesn't care about how much money, it cares about the momentum. As long as the momentum is positive, we're going to increase stock prices. Whenever the momentum, which means the amount of money, will slow down, it will still be more money added to the market. But if the momentum shifts, like if we just add less money than the previous month, that is going to be hell of a bearish signal for the stock market, because it treats with the momentum of monetary injections. We've been keeping a steady pace recently. If we ever talk about the possibility of ever sometime in the future starting to think, eventually thinking about temporarily reducing asset purchases, which means tapering the buying programs, then in that perspective, the market will definitely not like that. So it's all about this. It's not about the job market. It's not about the CPI numbers. It's actually truly about the momentum of monetary-based inflation. Basically, how much fucking money is going to be printed months ahead. If we ever start thinking about the possibility of reducing it with a timeline, which of course they will definitely don't do today, otherwise markets will lose the last remaining pillar that sustains prices. Okay? So that is what happens with today's Fed meeting. That's what's really happened. So there's one last thing we need to talk about. I have 10 years experience in the market now, and it's definitely not the biggest you will see out there, but I start to see patterns everywhere. Mostly the one that they have a seasonality into the way they put informations out there at the FOMC committees. And specifically, just like regular students, they have a nasty tendency to just release stuff in either August or September, kind of like going back to classes guy. Yes, that's the new policy for the week ahead, for the year ahead. And they generally tend to do this. Most importantly, I have clues, or at least evidence, that this is also the current market's mood, a professional market's mood. There has been a Bank of America study that's basically been putting all of the asset managers into some questions, asking them where they were thinking about the possibility to start thinking about taper tantrum. Okay, they massively said, like, I think the number is 76% of them agree on the fact that this will likely not be talked about until at least August or September. They're probably already talking about it, but not in front of microphones ever. They just don't want people to ever mention this into paper stuff. Okay, it's probably going to be questions about that today, but definitely not be mentions of it into the press conference. Okay. But still, people will assess the probability of it. So, of course, we have no momentum preceding the lecture. We'll see all about that. Eventually, a bit of volatility could emerge, but we're going to study the probabilities of it. So we're going to look at the VIX. Though the VIX is doing something really weird, because I never thought we would be making new low points over mid-April numbers, but we've succeeded doing such a thing. So that leaves me with two options. First one, I was damn fucking wrong, and in that perspective we are far from making the lowest points into volatility territory, and if for some reasons nothing ever happens today at the press conference, then we could just keep on pushing to the downside. Next breakout level would be below 13, which is enormously low level of volatility. Normally we're supposed to use log scales in here. So we could keep pressuring this thing to the downside. We sure think we can. This is where the trend channel stands, but this is also something that feels absolutely staggeringly stupid to me. We had signals telling us that it is not likely as being the most profitable option to bet for, but basically double bottom structures can still happen. I doubt they are very much the most likeliest outcome, but still probable. What leads me to believe that is the fact that we're damn oversold. But these are normally trends. which means the probability of a double top or double bottom in here feels very narrow to me. I'm not gonna avoid them anyway, because I've always been clear, I have absolutely no goddamn confidence into the price stability at the current levels of valuations we have in stock markets. That's the reason why, even though I'm losing money with those cover trades, I have them still, and I'm not going to release them now. So really tough question. So I'm going to focus on the technical levels. Now we're there. We're pretty much halfway through the trend channel. And what matters to me is, what's the next move? Are we going to go to the support, or are we going to go chasing for the resistance? So this is where the first level of resistance shows up. I think we could go there today with a bit of volatility into the press conference, but I think this is very likely going to be a resistance area. And in that perspective, pretty much like the last time, we double bottom out the support, we try to rebound, fail, and then we crash out toward the next level. Okay, so think about it. We can get a little bit of volatility today, but that could be just another false flag. The real shit happens if we fuck up the trend channel, which is the equivalent of this. Okay, but we need to pull away the logarithmic scale. Okay, that would be this or this trend line. Yeah, pretty much this one. Okay, so that would be the equivalent of this. If we get there and reject, well, that's the probability to go below 13.4 and try to settle in here for another support. Very likely going to be the last one, of course, for this one, but still possibility. Option number 2, we fuck up this trend channel. Next targeted levels are going to be above this resistant context, which is 45. Well, man, 45 is a level of volatility we haven't seen since the crisis itself. And in that perspective, shit really hits the fan. So if we ever get down to 45, that means we're going to get a flash crash. Expect something like 10 to 15% drops in asset valuations globally, S&P 500 drops. That's something I've always warned you about. That's the reason why I have a covered portfolio, just in case. Because if it happens, there are two options. Either you were prepared for it, which means you risk took in order to profit from this. That's exactly what I do now. And let me be honest, so far it's just the risk side that have been priced in for me. I'm just losing money because I could make some gains with my stocks. And I'm not, because I'm losing the gains at cover trades. So either I'm going to be just at a draw level, which means I'm going to lose money in one point and make it on the other end, which makes it just me totally off making profits in the market. But if it, of course, crashes out, I'll make a little bit of money to compensate for the losses. And like I said, I will probably get to buy again, which means I'm going to take those gains to buy and reinforce my existing stock market positions, okay? But I'm going to wait for shit storm to hit the fan. Basically, people panic selling or whatever, and we can eventually try to reach out the higher level context, which has been reversed as well and could be the reference. So in the worst case scenario, 60 to 65 would be accessible levels of volatility we could try to go right up to. Okay, so this is really like unexpectedly the Fed is giving us a taper tantrum today, which the market definitely not expects. Like I said, 76% of market participants, smart money participants, expect nothing to show up until at least August or September. So if they end up being wrong-footed by the Fed meeting today, they definitely are going to trigger a shitload of volatility. Okay, so unless an expectable, statistically improbable scenario show up today, very less likely going to get a load of volatility. Probability stands for us to get to 22, kind of a rebound, and then very likely crashing down the volatility again. So that means we can hardly trade the fucking stock market once again. So try to be smart. Have a balanced portfolio, not so much bullish, and certainly not bearish, unless you're experienced enough to figure it out. Because of course, if for some reasons the market was to go on a fireworks to the upside, then of course that means I'm going to take bigger losses. And if any of unexperienced traders were to try kind of trendy trades without the necessary knowledge in how to stop trades when they have to, well, that can turn out to be very much unprofitable for you, not to mention huge troubles ahead. Okay, so don't try to go corner trend, please. Just assess the fact that if stock market goes down, there is going to be an opportunity if you were smart enough to have some spared cash for it. So either you wait for it, and this is really what we've been talking about a lot into the latest updates. Okay, now time to go through the crypto market. So we're going to study crypto total first, and still standing into this range, very boring range. Everyone is bored about crypto, but still what I like is that technically speaking, we're finally terminating a bear cycle. We are going to start seeing emerging the bullish momentum trend line, which is pretty much going to show up in a few days. Okay, what I like as well is that the bearish resistant trail line is tested currently. And I don't think that there's any chance of it to be resistant, because of course we're not even in a sellable area. The minimum prices to sell are getting above it, so I think that's what's next. I think we're going to break above this 50% line, and God knows where we're going to go. In terms of crypto total, probability stands to me to get closer to the $2 trillion level into the broad crypto market sector, which means who's going to profit from this? Is it going to be Bitcoin orientated? Is it going to be altcoin season? Not alt season, but altcoin bullish momentum orientation. That all depends, of course, on the Bitcoin dominance, which I can hardly assess how complicated it is to figure it out. Of course, in here, we're totally bearish trending, so whoever has a bullish vision of Bitcoin dominance is just crazy. It's not. It's bearish, and it's still going to be. So sooner or later, we're going to figure our way down to the 36 level and make new all-time lows in terms of Bitcoin dominance. But the question is, what are we going to do first? It has been hell of a straight line move, so playing with time as an elastic movement in here feels like the most probable thing to me. So I don't think the Bitcoin dominance is going to go anywhere further than what it is now. I think we're going to oscillate across this 44 level, which means, well, today we're pretty much trading a resistant trading context, in which I'm definitely not going to be a buyer, okay? So I think the next move in here is to fuck up the bullish trend line. Trail line, because there's definitely no bullish momentum into such a market. So next move, in my personal opinion, is to the downside to fuck up this trail line. So I expect the market to go oversold, which I don't think is going to be done this way. I think it's going to be done like such a thing. Really low, slow depreciation and such a thing. Of course, I hardly can say how very little technical sentiment I have now for these market to build a bottom in here, because to build a top in here, because I have no signals yet. So I'm monitoring this stuff with the lower time frame signals, which are very limited at the moment. So I'm not betting on alts to overperform Bitcoin. I'm just thinking about the probabilities of them to pretty much maintain the same valuations one another. Okay? So I don't think it's going to be a Bitcoin season, just like I don't think it's going to be an alt season. I think it's going to be a boring, both of them working their way into the same direction. So that means Bitcoin can be studied at once, and then altcoins can be studied independently. Because of course, I think alts are going to be spread out the board. Some will recover just like Bitcoin does, and pretty much some might even overperform Bitcoin, because the rest of the shit coins will probably just keep dying, because there will be no demand for them. Okay, we've talked about that in the past. There's going to be a scattered across the globe kind of crypto market, specifically for altcoins. Good coins, bad coins, and how we differentiate them. I've talked about it. That depends on two major factors: the quality of the project, its vision for the future, its roadmap, the quality of its team behind it, the quantity of work to assess, the quantity of money poured in by smart money managers like first investment VCs and stuff like that prior to ICO. All of those things, or the quality of the ICO, the tokenomics, all of these things will truly matter a lot, along with the length and existence and history of the projects. Those who have longer history have an advantage over the others. Of course, for those who have managed to retrace up to 2018 high points. Those who failed, like the EOS and all others, they are under huge risk pressures because they have to prove strength. They have to sustain supports, otherwise they will lack of interest from smart investors. Okay, that aside, we're going to talk about Bitcoin now because we're already 23 minutes in. Okay, so on a daily perspective, Bitcoin is still into the same perspective we've talked about into the weekly updates. This is where the resistance stands, and we're pretty much going for it. The next resistance level stands across 48K level. This is where we get the first trend channel, which will validate the bottom in here as to be a two sets of waves to the downside structure, and that's pretty much all about it. Is it going to be a resistance level? I don't think it's going to be. I just think we're going to get there and see what's next. So what matters to me is, how do we deal with this area? We're currently testing a resistance, and I can hardly say how stupid that is to buy a resistance. But the question is, are we ever going to get a chance to go right back to supportive area? And that's what we're going to talk about today, because if we dive into shorter time frames, I would say I would definitely not do this. We're terminating a bullish cycle, but we're having quite a bullish momentum sustaining itself. I like the fact that we bought in here with a bull signal buying where the bulls are taking over. We are starting to get positive low points, so higher high points and higher low points is something that we cannot forget about. That's something I like. Still, the current short-term momentum is absolutely flat. And there's something additional I would like to talk about. I like this bottom with the range breakout pattern. I like the fact that it triggered a bullish momentum signal out there. I got them like all of these things, and that reminds me of something that no one has ever talked about lately, which still brings a lot of attention to me. I've seen a lot of people boasting for the Wyckoff patterns the latest few weeks because we had hell of a perfect accumulation, whatever, perfect distribution pattern, and so on. So, as I said, clap to those who've seen the pattern as it was playing out. Absolute bullshit for those who figured it out late and just have been relying on sharing the fuck to get visibility on the social networks. So fuck these guys. Okay, I've talked about the Wyckoff pattern and I've been real clear about that. When I mentioned it, it was way too late. I just wished I could have seen it earlier. So today, we're going to talk about the Wyckoff's accumulation pattern, because some people mentioned it when we figured out the distribution pattern being at play. Some people have mentioned the probability to see an accumulation pattern right after, and yet here we are, and no one's talking about it. So I thought about doing it today because I think we have a mature Wyckoff pattern actually. If we just take the schematics of this pattern, we'll see that the similarities and the maturity, in my personal opinion, already there. Let me be real clear. So of course, figure it out. The pattern never replicates the same way. It's just kind of a psychological replicate patterns. So what matters to me is, did we find the intermediate maturities already, and where could we be now? Let's try to forecast this. So of course, the first dip in here is the short momentum boost. Okay, we rebounds. That would be this one. Okay, then comes kind of an hesitation in which we rebounds between support and resistance for a few oscillations. That would personally be this for me. Okay, that would be this sign in which we rebounds. Okay, we oscillate across, and okay, then comes a very interesting phase. We try to dip below. Okay, that would be this for me, because this is where we've made lower candle closes than the previous two bottoms. So this and this would be kind of the two intermediate bottoms or whatever, these sideways area. This would be the retest. This would be the harsh reactivation. As you can see, harsh reactivation, then slow down into the momentum. It's exactly what we have. Then we can see that there's a violent move to the downside again. That fails pretty much into the same price area as the previous one. Okay, that would be ST7. Then we slowly, and that's what I like, multiple subwaves to get to rebuild the momentum to still a lower high point. Okay, sideways action to build still a lower high point. Okay, that's the descending trend line. Then comes the creek, which is we go slowly with a trend line a simulation, which is basically no more than this trend line. Okay, so the creek shows up. We go there, and there's an acceleration. We break down the momentum of these temporary trend channel, whatever. Okay, so this was it. Break it down, huge cluster to the downside, attempt to break down the low points, range opposite signal, which just tells us that this is not a trend that's going on, but just a stupid bottom. Like we said, the reversal signal. As we get oversold, people reactivate to the upside very violently, and then consolidate, makes another violent upside move, and consolidate again, kind of these SOS patterns. We've had the first one in here, and the second might be at play now. So, congratulations, guys. We've got an accumulation Wyckoff pattern, totally mature. I see the psychology, I see all of the patterns and intermediate maturities totally validated. So, I'm wondering, am I going to use this pattern, yes or no? I can hardly do this. I don't know the pattern. I've studied the technicals, sure thing, and they're already that fucking complicated. So Wyckoff patterns, I still stand for what I said. I don't think they're actually worth it. They have too much information to process them correctly for too little of real market exposition for these patterns. So very little probabilities to profit from it, and very much fucking complex things to study to get to master these. Not to mention that I know the technicals, and I certainly don't know anything about the risk management. Where do you actively trade this pattern? Where do you put the stop losses? And so on. They teach me about the potential maturity of a psychological structure. And I tend to say that I will use this information, but I can't trade that all alone. I'm going to have to trade with something I know, something I have experienced about, my fucking strategy. So what I like to do in here is not to trade the Wyckoff pattern itself, which most of you guys will eventually turn out to do, and that would be a stupid mistake. You don't trade a pattern you don't master. You might eventually want to find significantly reliable context that come along with it to profit from this. So try to figure out parallels from the Wyckoff's distribution accumulation pattern down to your personal strategy, because you need to use your strategy, not the Wyckoff's, okay? So that's what it is all about. So like we stated, it's going to look like a range in which we are supposed to exit from the upside and finally get away from the resistance. This range is supposed to build over the market resistance area, which we're currently trading in. So is the range we're currently seeing into the short term in Bitcoin the range that comes from a probable second SOS pattern? Yes, it is. So how can I deal with this? If I am truly into a Wyckoff pattern, this is a trend pattern emerging. So what are the trend patterns I can use in such a context? Well, first and foremost, I'm going to go into 2 time frames below, and we'll see what we have. Do I see the range into the 15 time frame context? Give it a second to plot. Congratulations, yes, I see it. The market still goes to the upside, the context is still rising, and we have something that looks like a trend. So, do I have replicates of the sentiment that the Wyckoff pattern is supposed to print on prices? That's a big fucking yes. I have something that looks like a range, but looks like a fucking bullish range. Something that is far more bullish than more typical ranges. I have signs of maturities for ranges, which means I might be able to see a structure. Yes, I have it. It is a fucking flat range. So I have a matured flat range in something that looks like a bullish trending range, whatever. And we're supposed to break it to the upside if the Wyckoff pattern is truly at play. So what am I going to buy? I need to buy something I know. If there is a trend follow pattern, if this is a trend, then buying the moving average is something I can do. Because remember, buying the goddamn moving average is a trend follow opportunity. In that perspective, I'll put the stop loss out of the lowest time, at the higher time frame low point, which is quite an expensive stop loss, but that's going to be something I know. I know the risk management for this pattern. I'll definitely do it. So if we retrace to the moving average, you can be damn sure I'm going to buy, because that's something I know. I'm not going to trade the Wyckoff pattern. I'm just going to use the Wyckoff pattern as an initiative idea for my personal trading activity. Using my fucking patterns. Don't twist your strategy to use someone else's. Just try to find potential replicates on your own strategies if you ever intend to use some other trader's stuff. Okay, so this is something I know. Buying the moving average, putting my stop losses out there, 2% maximum risk taking. I'm going to do it. I'm definitely going to do it. Another thing I know about is I can trend follow by breaking the third range boundary. If I've got a mature range, that means I already have a third range boundary. So where would it be? Oh, damn it, we haven't reversed the context yet, but it seems like I have a mature range, so I'm going to go for this. I'm going to say this is pretty much like a weird type of range, and this would be my reference. If we ever break out this level, then you can be damn sure I'm going to buy. I'm going to break out buying out of the current range. So 41.3, I'm going to break out trade. This means I'm going to take a 1% risk in here with a stop loss below the current low point. And trend follow this thing, which means I'm going to leave it opened as long as possible, as long as it's not stopped out. So I'm starting to have context I can favor. A breakout trade, a moving average breakout trade, a moving average pullback trade. All of these things are things I can use. On the higher time frame, I can use trend follow trades on the trend channel side, which means just one time frame above. I could buy trend signals on this trend channel. So I could wait for the market to test this trend channel, but in that perspective, there is one structure I know. I could buy the overlapping structures in here. So in that perspective, there is a minimum requirement to get to break this area, This is where I've got my moving average buy entry, by the way. Okay, but its stop loss is in here. And in that perspective, you could eventually inch one way lower, trying to get to the overlapping level 38K, in which there will be a fairly much attractive price to buy. I've got all I need. Patterns I know with their respective risk limitations. I'm going to wait to get the expectable price moves. Price will tell me what I'll trigger. Either that's going to be a 1% risk breakout trade or a 2% risk trend follow level with a large stop loss. Okay? Or eventually, if I have nothing on the moving average side, I'll eventually consider buying the overlapping level over 38. I know that anyhow and anyway, I'm going to buy. So if I've got nothing in here, I'll eventually save my entry for this. If I've got mixed signals in here, I'll eventually take 1% risk in here and 1% risk in here to split the risk into the two areas. Anyhow and anyway, the breakout situation is just going to be a 1% risk to me because it is a volatile context and we've got a fucking Fed meeting today. So I'm definitely not going to breakout trade with a huge risk if for some reasons that would just be a stupid trap during the Fed meeting. Okay? So if it turns out to be a trap, I'll take a 1% stop loss. No big deal. That happens a lot. Okay? So these are the things I care about. These are all the buying patterns I can use because these are the patterns I know. All right, guys? And I hope you've understood that. That really is something you need to understand. Never trade someone else's strategy. Trade your own. And if you think like someone else has a smarter vision of markets than you have, then you can process their information into your strategies. But these are informations. These are definitely not tradable signals. If someone else's trade, you just can't copy trade him. You're just going to have to assess that if he found a buyable or sellable context, then you should too, with your own knowledge. That's it for today, okay? So pay attention to the Fed, be aware of the Wyckoff's accumulation pattern, and once again, I think today it matters a lot because we can see it as it plays out, and we're into the most interesting part of it. That doesn't mean it's going to happen. It just means this is statistically very viable to me, and I'm definitely intending to trade it. Bye, guys.